Well, meantime, we get the latest numbers on inflation this morning when the Labor Department releases the Consumer Price Index. Those figures may show that inflation was unchanged last month. Joining us now to kind of preview the data is James Knightley, economist at ING Financial Markets in London. Hi, James. Thank you so much for joining us.
Hi, morning.
So let's start out quickly with what your estimate is, because it is slightly above estimates. You're expecting a 0.2% month-on-month for both headline and core. Talk to us a little bit about why you're above consensus there.
Yeah, well, I think on the core number, we're looking for the auto prices to be a little bit higher, actually. We've seen some of the second-hand prices creep a little bit higher in some of the auctions. But in terms of headline, I think there is a bit of a risk from gasoline. A lot of people are talking about energy prices being less of a contribution this time round. But I think if you look at what's happened to gasoline since the start of the year, it's actually risen about 44% or so. And now on the retail prices, but within CPI, it's only up 20% or so. So there is a divergence there. And I think we could get a little bit of catch-up.
But to be fair, I mean, we're looking at a 50% decline in the price of oils compared to last year. So do you really think that that's going to play into it as much as you might think?
I think it is. I mean, we're going to be seeing oil making a more and more positive contribution to inflation over the next few months, because you remember, oil peaked back in July the 3rd last year. It's since actually fallen a significant amount, but now it's moving up again. And I think that sort of year-over-year comparison is going to shrink and shrink and shrink, and that suggests that we are going to be getting higher headline numbers over the next few months. So there is a bit of a risk for the bond market that the creep higher in CPI may come a little bit quicker.
James, I was taking a look this morning at the break-even rate, essentially for our viewers, the difference between the yield on the TIPS Treasury and the nominal Treasury, and price is expected to rise 0.2% over the next 2 years. Do you think that the market is accurately pricing it in? Because there's such a huge divergence with what economists are expecting and with what the market is actually pricing in.
That's right. I think there is going to be a big catch-up here. As we've seen, you were talking earlier about the recovery story. More and more people are becoming more upbeat on the recovery story. And if that's the case, coupled with the fact that energy prices are going to be much less of a drag and could potentially, over the next 12 to 18 months, be a positive thrust on inflation, then I think that is going to see a market shift in sentiment.
And James, one final question here. If you take a look at the break-even rate going out to the 30 years, because obviously more inflation expected on the higher and the further end of that, it's at 2.1%. Do you think that the market is accurately pricing in that inflation long-term?
That seems a much fairer valuation, really, to be honest. I mean, we are looking for inflation to be around a 2 to 2.5% range, you know, once we get out of the malaise that we're currently in. So I think that's a much fair, accurate reading.
Thank you so much. James Knightley, economist at ING Financial Markets.